Hi, and welcome to an early global view on Tuesday, March 29th, 2016. It's currently 6:45 a.m. U.S. Central Time, and we wanted to make sure we had an early update today because Janet Yellen speaks at 10:30 this morning, U.S. Central Time, to the Economic Club of New York. This is very important because Ms. Yellen has been the somewhat more dovish voice, and if we go back 2 weeks ago to the FOMC projections and press conference, everyone thought the FOMC's, what I consider irrational normalcy bias, trying to convince everybody everything's back to normal when it's pretty clear that it's not, especially globally, had gone by the wayside. The projection showed the likelihood of only 2 rate hikes in 2016 versus the 4 they were projecting previous. But then last week, we had Messrs. Harker and Dudley say, nope, April meeting's live, and we still think there should be 3 hikes this year, which is a big difference from 2. And just yesterday evening on Monday, Mr. Williams from the San Francisco Fed said that he felt there should be 3 hikes this year. So we're coming down to whether the Fed's going to be more accommodative or more hawkish once again. And this is important along with all of the other data we're going to see this week. And the data remains weak on balance. And what has all this meant to the markets? Well, into and after the holiday weekend, where, of course, Europe and the UK and Canada and Australia, for that matter, were still out on Monday, we come back today, and the S&P 500, after a quiet, choppy day yesterday, is down 5 at 2023. Now, this is not any big, decisive consideration. As we've said on quite a few occasions, the bigger, lower supports down in the 20 to 10 range, and of course that now has a buffer to this Fibonacci retracement level at 2008. The resistance is up at around 2035, which the market, of course, once it got up there in the wake of the March contract expiration going back to the 17th, it pushed above 2020 and got above 2035 and wanted to range above it to not quite 2050, which is the next resistance overall, but then failed on the back of last Tuesday and the Wednesday's Harker's and then Dudley's comments about maybe there are more hikes coming. So you can see how this is somewhat of a Fed psychology-driven market right now. But even though it gapped lower back on Thursday into the 2020 to 2010 range, of course, never even quite got to 2010. Now we've got this current upward channel, kind of important, broadest upward channel for the current trend. That's down at 2016 early today. By later on today into early tomorrow, it's more so up around 2020. But you have to allow, on a short-term view, there can be a breakout below this channel, but you still have to watch 2020 to 2010 as an indication of whether the market is holding on, as we'll see on the intermediate-term charts. It's also important that the strength going back to Thursday into the early trading this week has taken the hourly MACD back up above its lower runaway band. So if this market weakens in an orderly fashion, as long as it's not below or at least staying below this lower runaway band for any length of time, it's probably still okay. And that pretty much does it for the short-term view of the S&P 500.